Well, good morning, everyone. Thomas Montgomery. We get together with our distribution partners most weekday mornings, this time, 8 o'clock Central. Today is Monday, April 4th, 2022. We did announce back on Friday that we have a new contest, a new incentive that anyone that refers in at least 10 clients in the month of April will be entered into for a free trip to Las Vegas. That trip will be the week of Memorial Day weekend. If you can't make it, we'll just pay cash. The top 10 performers in the month of April will be able to join us for that leadership retreat. And if you need more details on that, just refer back to this past Friday's training. Today, we're going to revisit AR financing, accounts receivable financing. And this is a really big deal, but we do need to understand how it works. So there's no missed expectations and also no missed opportunities. So what did you and I learn in school? If you want to borrow money, you have to be cognizant of the 3 C's: creditworthiness, collateral, cash flow, sometimes called capacity. Do you have to have all 3 C's to borrow money? Absolutely not. Thus, do you have to have good credit to borrow money? Absolutely not. But you must have at least one of the 3 C's. Now, the more the better, and as technical advisors, that's what you and I do to help people become more credible on paper. But I think you're going to frequently run into individuals that need capital, need funding, they need money, but they don't qualify from a credit perspective. And instead of dwelling on that, we probably need to pivot from a credit-based capital raise maybe to a collateral-based capital raise, which we're going to talk about today, and that is accounts receivable financing. So we're going to go through a step-by-step guide to getting accounts receivable financing. We did a similar training to this in March, but since then we've enrolled a lot of clients in the collateral support program and realized that we needed to present it a bit differently so everyone can understand it. So here we go, and we've actually drilled it down to just a 3-step process now. So let's start with identifying what accounts receivable financing is, because why this is relevant is that you and I help solve a problem, and that's small businesses accessing capital. We can't help but the fact that the 3 C's apply. Again, credit, collateral, cash flow. Do you have to have all 3? Absolutely not. Do you have to have at least one of the 3? Absolutely so. And I would argue that collateral is the easiest and the quickest to access for someone that's starting from a low entry point. All right. So what is accounts receivable financing? And we're going to go through some of the lenders that are leaders in this area. So this obviously is true and factual, but we'll get to them in a minute. All right. So accounts receivable financing is asset-based financing that allows business owners to access capital that is secured by outstanding invoices. So again, let's think about this. 3 C's. If someone had good credit, that shows the lender that they paid their bills in the past, and that would give them confidence. Great. For cash flow based financing, if a company has a lot of cash flow coming through and they've done that long enough and strong enough, then that can serve as the single criteria to get funding, because the lender would say, well, it's been happening consistently in the past. We think it'll happen in the future. And that is reason enough to extend financing to them. Today, we're talking about the 3rd C, collateral. And so if you have enough of the right type of collateral, that can provide access to funding. So that's what we're talking about today. Now, what I understand is a lot of the small businesses that you and I work with, they come to us and they don't have enough collateral. They don't have enough accounts receivable to do this on their own. So we need to supplement it. And that's part of the solution to the problem that you and I help with. We'll get to that in just a moment. So accounts receivable financing can be structured in multiple ways, usually with the basis as either an asset sale or a loan. So I could give you other examples, and I guess I'll give you a couple. One of the programs we used frequently, I worked at the SBA, was called a ROBS plan. What a horrible acronym, ROBS, but rollover for business startups. And so it wasn't unusual that we would have clients that had worked as a W-2 employee, was moving into self-employment, and they had a retirement program. And so would we have to cash out on that retirement program? No, we used it as collateral because it was something that provided the lender security interest in case the borrower didn't pay back. I think the largest deal that I did with that was to open a Gatti's Pizza, Gattis Pizza, with a client of mine. We raised $1.2 million. But regardless, it can make sense that if someone brings the right type of collateral and the right amount to the table, then that can be enough to be able to access funding without regard to credit and, frankly, without regard to cash flow. Third bullet, accounts receivable financing company will advance up to 100% of the value of a given outstanding invoice. Now, there's two models of this. There's what we'd consider AR financing and then AR factoring. We'll group them together for the time being. Qualified unpaid invoices serve as collateral, so you're not required to provide additional collateral, nor in some cases even verify credit or cash flow. So again, the 3 C's of borrowing money, same as you and I learned in school. It's great to have all 3 C's. Do you have to have all 3 C's? No. We can access funding off of any one of the C's alone. Credit, for example. We've helped clients raise over $100,000 quickly off of credit alone, even frankly, when they didn't have cash flow to support it or any collateral. Can we get money just off of cash flow? Yes. And here we're talking about getting money just off of collateral. Last bullet, because the invoices serve as collateral, accounts receivable financing can be a great solution to borrowers with bad credit and also those without adequate cash flow. So maybe this is new to you and you're saying, invoices, what is this all about? Well, what we're doing with the collateral support program is literally transferring, legally, ethically, morally, transferring assets to the client's balance sheet. So now they have $100,000 or more of accounts receivable on their balance sheet. We've had separate trainings about this, and my goal today is not to go too deep into that, but instead to go through this 3-step process. But just so you know, where we get these assets that we're talking about for accounts receivable financing can come from the collateral support program. If you have questions, comments, concerns as we go through, just go ahead and type them into the Q&A. I want to welcome Reese. Reese, frankly, was our top performer over the weekend. I don't know the exact count, but I'm going to guess that Reese submitted about 50 deals over the weekend in a 48-hour period, 50 deals. So right now we expect to see Reese in Las Vegas. But if anyone has any questions, just post it to Q&A. All right, so what's the 3-step process of leveraging AR financing? The first is we get the client in the collateral support program. Now, if the client already has collateral, do they have to enroll in the collateral support program? Of course not. And that's the beauty of what you and I do. When we're taking people through the 4 modules and we look at their balance sheet, we'll quickly understand in a very consultative, very organic way, you don't have a very strong balance sheet to serve as, you can't demonstrate that you have collateral for the loan that you're looking for. What if we were to help you add $100,000 of receivables to your balance sheet, which would strengthen your balance sheet and give us another option for funding? So with that being said, again, details are on the business paralegal site collateral support program page. And this isn't a barrier because we do in-house financing on this with guaranteed approval. So hopefully what you're discerning as we go through is this is a really big deal. This is probably the magic bullet for many of your clients that want funding, but that don't otherwise yet qualify. So this is something that we could be using for your current clients that are in the pipeline, and or to even attract new business, just like Reese is doing. Okay, so that's number one. Step number one is real simple. We need to get them enrolled in the collateral support program to get them $100,000 of accounts receivable. Now, I know the question that's what Lon's asking is, well, wait, what if they want more than $100,000 in funding? What are we going to do then? Well, then you're like Phil. Take Phil, one of our white label partners. Phil helped 2 clients in the past 2 weeks each get 6 portfolios because their capital raise goals were larger. They need around $500,000 apiece. So with that, we can stack multiple portfolios of receivables to qualify for more and more funding. And we'll talk about where the funding comes from and how we liquidate in just a moment. But thank you, Lon, for that question. Okay, so we got a 3-step process here to leverage it. Step 1 is pretty simple. More information on the reference page. Okay, so let's move on now. Now we're to step 2, which is leveraging the accounts receivable. And again, if accounts receivable doesn't make sense, that's what the client is buying. So with the collateral support program, they're buying a portfolio of accounts receivables. Okay. So what we're going to do then, and we actually have a department, which I'm not in, but I understand enough to be dangerous, but we have a department that's going to work with the client and help them post that AR in their QuickBooks. If they buy multiple portfolios, of course, same process, just repeated. And then part of that process is having the debt buyer, in this case, the client, recording each client and then sending an invoice out to them, because it's called chain of title. We need to establish that these receivables are now owned by the debt buyer. Let me give you an example. Let's say I have a John Deere tractor and I don't need the John Deere tractor anymore. So I'm going to sell it to Denise. Denise is on the Zoom this morning. And so could I just give Denise the key and say, and collect some money from her, and she just drives off or loads up the tractor on a trailer and she leaves? Well, that really doesn't transfer ownership legally. There needs to be a title transfer. There needs to be the paper trail. And so that's part of what we do to make this legal and ethical and effective, is to truly transfer the chain of ownership over to the debt buyer. And so we also will help the debt buyer put these receivables into their QuickBooks or whatever software, small business accounting software that they're using, because each of these agreements have daily $50 late fees. So if we step back, why would someone want $100,000 of accounts receivable on their balance sheet? Well, it gives them assets that can be pledged as collateral, right? So that's good. But secondly, it also improves what's called their income statement or profit and loss. Balance sheets show assets and liabilities as of a specific point in time. In contrast, a profit and loss or an income statement, means the same thing, shows income and expenses over a period of time. Well, a lot of our clients really don't have much income going on yet because they're early stage. Well, this helps. How does it help? Well, let's say that there's 10 accounts of a $10,000 each that is now part of the portfolio that the client has purchased. Each of those contracts have daily late fees. So that means that the debt buyer, the client, now is able to show $500 a day, 50 times 10 accounts, $500 a day in late fees, or over a 30-day month. That's $15,000 of income. Now, I'm not saying that they collected all of that yet, but what you and I learned in accounting, right, is that the accrual method of accounting recognizes income when it's earned, not necessarily when it's received. So this is huge for strengthening the credibility of the client, of the debt buyer, by building their balance sheet and income statement. Then we work with them to position those receivables to be primary notes that they could be factored or sold or financed through accounts receivable financing. And then we also want to include that AR in the balance sheet of the loan package so that the business looks credible. So that's steps 1 and 2. Now we get to step 3, and step 3 is really what everybody cares most about, right? They want the outcome. How is it that we go about to liquidate? That's the verb. How do we liquidate the accounts receivable? And we commonly talk about this. This is not novel. This is like with any business, right? You could own a catering business and you might get contracts to do catering, but what you really want is the cash that comes from that. So at some point, anytime we have, as a business owner, if we have accounts receivable, we want to liquidate that accounts receivable to get cash. There are 4 primary ways that that can happen. Let's go through those now. The first of which is collections. And that sounds like a harsh word, but that just simply means that we're collecting the money that we're owed, right? Someone has an agreement to pay, and so we need to ask them to pay. And some people will pay voluntarily, and some we have to prompt them a little bit to remind them of their legal obligations. But collections would be the first way to liquidate accounts receivable. And that can be done either internally or through outside third-party collections. So that's the first way to liquidate. The second is to litigate. Sometimes just the threat to litigate will motivate people to pay. But what you and I have seen in life is some people don't pay what they promise to pay. And so if that's the case, then there are attorneys that will draft up demand letters. There are attorneys that will actually file suit to collect the money without charging you or the client anything. That they just collect from the debtor. And so that would be the second way to collect money. The third is that this can be resold. So debt is bought and sold on a regular basis. Just a lot of people aren't familiar with it. So, and this hits to Reese's question. So historically, it's been defaulted mortgages, defaulted auto loans, and defaulted credit card debts that have made up the largest amount of transactions in the marketplace. There are, though, other types of debt instruments, such as medical, professional services, and so forth. So getting back to this, so that the debt can be resold. And then the fourth, which ties back to our topic today, and that's where we'll wrap it up, is that we can also use accounts receivable financing and or factoring. And there's a variety of lenders. We listed a few of our favorites, but there's others. And the lenders will advance a portion of the invoice's value, usually 80 to 90%, rarely less than 50%, but up to 100%. They have to look at the portfolio before they make an offer. And then that gets the client funded, and they can use the money however they want. In other words, it's unrestricted funds. They could use it to pay off other debt. They could use it to take trips. They could use it for their business. It's unrestricted funds. So with that, just to give you a few of the preferred lenders, and there's dozens and dozens of lenders in this space, but just to make it more tangible, there's Crestmark, one of my favorites. Crestmark will fund up to 90%. Remember, we said that there's different ranges. You know, usually it's 80 to 90%, rarely less than 50% of the AR's value, but up to 100%. But Crestmark will go up to 90% within one business day. And you can go to their website and validate that. I'm telling you the truth. And what's nice is Crestmark will work with startups, as will many of the others. Not all the others, but many of the others. There's other preferred lenders in this space, including Fund Through, First Commercial Credit. And if you need others, I can give you others, but we'll help them with that, right? So let's talk about what's in it for you. So as a distribution partner, you can be a debt buyer and thus a debt seller. And so you would buy a portfolio and then you could resell it. We make it available to you for 10 cents on the dollar, and then that's called wholesale, and then you could mark it up to retail if you would like, commonly 15 to 20 cents on the dollar. So you make a margin off of that. And then your client that has bought the portfolio from you, then of course can go through this process, liquidate, and receive the benefits. So why is this good for you as a distribution partner? Well, number one, it helps us position more clients to get funding more quickly because it's a different C. Most people are stuck on, of the 3 C's, credit. My credit's shitty, I can't get funding. My credit's bad, I can't get funding. Well, either fix your credit or pivot away from credit-based financing. Here, we're talking about financing that is asset-based. So what's in it for you? You can help your clients get funded, and if you'd like, you can be a debt buyer yourself, whereby you buy the portfolio and then you resell it to the client at a markup. We don't charge you anything to be a debt buyer. There's no fees. We've got in-person trainings that we're doing now that's free for you to attend, or we can train you on the fly. All right, so let's get back to questions, comments, concerns that any of you have, because let's take Jeremy that's on the line here. Good morning, Jeremy. Jeremy has generated, I'm going to guess, close to 100 prospects over the past 6 months. Frankly, not all of them have moved forward. This is another talking point that he could go back to those 100 plus or minus and say, you know what, we have another way to help you get funded that you might not be aware of. So let's get you engaged. He could use that to get them brought into access to capital as the carrot, or frankly, we can do this on a standalone basis. A client does not have to be in access to capital for us to help them with the collateral support program. But I will tell you that's the norm, because if you bring them into access to capital, then we look at their credibility on paper, we look at their balance sheet, and it becomes real apparent when there's a disconnect between the amount of capital they're looking for and the amount of collateral they have. All right, so let's go through the questions, comments, concerns you have, and I think we've addressed some of these already, so let me clear them out. Wednesday asks, can I email this out? Yes, we'll get the recording out to everyone, hopefully today. Des asked the small deposit. So when we sell the portfolio at wholesale, we sell it for, and I mentioned this, but probably not clearly enough. So thank you, Des. So we sell it for 10 cents on the dollar. So a $100,000 portfolio sells for 10,000. We know a lot of people don't have or don't want to spend 10,000 out of pocket. So we provide 0% financing, which is what Des is asking. There is a small deposit. So we charge 1% down, the rest we finance. So it's perfect. So that was the answer to Des's question. And Reese asked, can funding start when people are just starting? Yes. So while I want to give a transparent answer. So we can start liquidating the accounts receivable right away. That's the goal, right? No matter which of the 4 methods of liquidation, that's the goal. That's why we would buy a $100,000 portfolio of accounts receivable. Showing it on the balance sheet is great and effective, but we also want to liquidate it. We want to turn that into cash. And so, yes, Reese, we can start with that immediately. All right, Denise asked, is there a certain amount of time that the assets must show in the balance sheet for loan approvals? No, I did not that I'm aware of. Okay, so let's do a quick review and then see if there's any questions. So our topic today was reviewing accounts receivable financing. It's leveraging one of the 3 C's that most small business owners don't think about. There's credit, there's cash flow, and there's collateral. You and I can literally create the collateral on the client's balance sheet that they can go through the simple 3-step process as we've reviewed, and we can help them begin immediately start liquidating that to turn that AR into cash. And there's 4 different strategies to do so. There's a number of different preferred lenders, and we've given you the overview. I do encourage each of you to go to Business Paralegal on the collateral support program to get more familiar with our solution that helps the clients be able to use accounts receivable financing. But are there any other questions that any of you have today? Covered a lot of information. Maybe it's a refresher for some, but this should be very empowering. If you have clients or can get clients that want funding and frankly don't qualify for anything based upon credit, this is a really good solution. Also, if you have clients that are wanting funding that they can't provide the collateral that the lender might expect, if it's that type of funding, then this can also be a solution. But this is commonly overlooked. It's a great way to help small businesses very quickly. All right. Well, thanks, everyone. I'll talk to you soon, and we'll see you back tomorrow morning, same time, same place. Bye-bye.